mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in roughly 45 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and unfortunately tonight I am not joined by my equity buddy Ren, but that's okay, the show will go on. And to keep in theme with, the last month or so, we're going to be doing another expert investor interview, this time with Managing Director of Russell Investments, Jodie Hampshire. So the key to tonight's episode is all around financial advisors and the value that financial advisors can bring an investor at, particular points in your life, depending on whether or not you need one. Jodie and her company have just released their second annual Value of an Advisor report. And so we're going to dive a bit into that to unpack it a bit, to really understand how advisors can add value to your long-term returns. So we hope you enjoy. We will be returning back to our normal episodes quite soon. So stick with us, and we'll do an Ask Us Anything at the end of this month. Looking forward to it. Enjoy. So tonight we're very lucky to be joined by Managing Director of Russell Investments Australia, Jodie Hampshire. Thanks for joining us on the show tonight.
Thank you for having me, Bryce.
So unfortunately, Ren couldn't make it due to technical difficulties. So we're going to get on with that anyway because, it's a pretty important episode. Today, we're going to be discussing, obviously, Russell Investments and a new account offering that you offer, but also your report that has just been released called Value of an Advisor report that really goes into talk about the value that a financial advisor can give investors on a per annum basis. So really looking forward to getting some insight into that. But before we do, we always like to open our interviews with a bit of a game. Hopefully you're up for it. It's called Overrated, Underrated, and the idea is that I'll just throw a couple of asset classes or investing ideas at you, and I'd like if you could let me know if you think they're overrated or underrated, and perhaps why that is. You up for it?
I'm up for it.
Okay, so overrated, underrated, the Australian equities market.
Neutral. Am I allowed to say neutral, Bryce?
You can.
If I explain it. So we think that the Australian economy is going to muddle along. So the Australian market and Australian stocks will be very much stock-specific stories. We don't expect recession here, but we're not expecting huge growth either.
Okay, I will accept that neutral position. So then, overrated or underrated, the American equities market?
Overrated. We are very, 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 very late in the longest bull market in history. And based on the way we think of investing with a long-term valuation basis, we think that American equities in general are overpriced.
Okay. Overrated or underrated passive investing?
Probably a little bit overrated at the moment. We think passive investing has a place in portfolios and are pragmatic about its use, but I think a lot of investors have been wowed by really strong returns in the bull market, and what they're missing is that often passive management is less diversified than active management.
So overrated or underrated ethical funds?
Underrated in general. So we think that environmental, social and governance factors in general have a real impact on the financial performance of an asset. But we want the managers that we work with, we're a multi-manager, we want the managers that we work with to be incorporating assessment of those factors into the financial assessment of a stock. So it's part of the overall stock assessment. It's not a special add-on thing, if that makes sense.
Yeah. So moving away from equities then, overrated or underrated the Australian property market?
Or probably overrated. We quite like unlisted property assets, depending on valuations.
And moving to cash, overrated or underrated term deposits?
I think overrated, particularly with rates going down. And I understand your membership in general is fairly young. term deposits ain't got no place in a young investor's portfolio, in my personal opinion.
Well, I'd like to explore that a bit later. So that's interesting. Lucky last, overrated or underrated listed investment companies?
Oh, it really varies. So I think probably overrated is what I would say, just because there's a tendency for the asset valuation to diverge from the price quite a bit. We like to invest in things where we understand how net asset value is calculated.
Mm. Nice. So that brings us to the end. Some pretty interesting insights there. Touch base a bit later on the cash side of things.
Sure.
But before we do, so as I said at the start, you're the managing director for Russell Investments.
Mm-hmm.
You're also a member of the firm's leadership team and Russell Global Council.
Mm-hmm.
Let's go right back to the start. And are you able to tell us the story of your very first investment?
Yes, I can tell you the story of my very first investment. So my very first investment was in a managed fund, was in Russell Funds. So I guess I'd drunk enough of the Kool-Aid as a younger investor to think that diversification was, we say diversification's the only free lunch. And so that was on one side of things. On the other side of things, I only like to invest in things that I really understand, and I'm very, very time poor. So I have not invested in specific stocks until later in my life. I've done different things.
Yeah, right. That's interesting. Is there a reason for that?
For not investing in stocks until later in life?
Yeah.
So I think I've invested in markets through managed funds, as I've said, and so I'm a big fan of outsourcing. So things that I'm not particularly good at as an individual, or things that I don't have sufficient time to dedicate to, I will outsource. It applies to lots of aspects of my life. But from an investment perspective, I want to make sure that that I've got the best investors in the market looking after my money. So I invested in a managed fund. I knew the people that were running the Russell Investments managed fund, so I was happy putting my money there. There's also an aspect now, if you like, if I'm speaking to our clients about the funds that we're running for them, they get some comfort that I put my money where my mouth is and am investing in the same funds. Our interests are aligned. But I have broadened my investments from managed funds over the years into venture capital, ETFs, and individual stocks, as well as investment property.
Yeah, nice. So let's have a bit of a chat about Russell Investments then. Can you give us an idea about, I mean, what do you do and what's your guiding investing philosophy?
Okay, so Russell Investments is a global company headquartered in Seattle. We've been in Australia for over 30 years. Globally, we run over $400 billion of assets for clients. And in Australia, we run about $30 billion of assets for our clients. The types of clients that work with us, we run the superannuation assets of some companies like News Limited, like Fujitsu, like Nestle, like CSR. We also manage the investments for some specific superannuation funds. And we also partner with financial advisors who use our managed funds, ETFs, and now managed accounts to deliver investment solutions to their clients as well. So our investment philosophy, so our purpose is improving financial security for people, and our investment philosophy is a multi-asset, outcome-oriented investment philosophy. So we started life as a multi-manager investor. So this is the concept where we pick managers who are good at picking stocks. So in an Australian equity portfolio, we'll choose a range of managers and put them together based on our assessment of who the best managers are in the Australian equity market. And they'll change over time. So we're hiring and firing managers based on our assessment of a manager's skill at a particular point in time. So our history started there, but we've broadened. Today's investment world requires investors to be more dynamic. We have about $50 billion of that $400 billion globally invested directly. So we will do things like add a factor portfolio to a multi-manager portfolio where we can't find a good manager to fulfill a particular role, or where we can't find a good manager at the right kind of fee, or we've got some kind of portfolio level gap that we want to fill. So that is behind the change in definition from multi-manager to a multi-asset manager. And we're all about achieving our clients' particular outcomes.
Interesting. So you actually almost outsource the management side of things and just aggregate groups of managers to then run the products that you provide?
In the main, but the thing that's changed for us probably in the last decade is that in the old days, so multi-manager has been in the Australian market for 20 plus years. And there used to be this sense that in a multi-manager portfolio, you'd get what you get and you don't get upset. Like you get whatever the manager's positions in aggregate add up to. Now, we certainly have the ability. So we own total portfolio outcomes. So yes, we might be hiring underlying managers, but we're responsible for delivering the particular outcome that we've told our clients that we'll deliver. So that's when we'll use those in-house proprietary positioning strategies or smart beta or factor portfolio strategies to make sure we're comfortable and delivering on the total portfolio.
Right. So it's a combination of both the skill of the manager you hire and also your internal proprietary approach.
Yes, that's right, Bryce.
Interesting. So do you have, out of interest, do you have managers coming to you saying they want to, be part of Russell, or do you have to go out and find managers based on the skills that you need for your products that you offer?
It's both. I think because we're a large global investment manager and we also consult on a huge number, off the top of my head, a few $1 trillion in assets as well as managing assets for clients. New managers will come to us because they want us to rate them and to consider putting them into our clients and our funds portfolios. What happens though is we tend to have career manager researchers. So we have people that will spend their entire career following the career path of individuals and organizations in a particular sector. So often we'll know that, Mary and Fred have left this particular investment manager. They've started up their own thing over here. We've known them for 15 years in their old shop. So we've got an idea of how they invest. And so that longevity of manager research means that we're able to follow people and often are one of the first investors in a new manager because we know the people in the market very, very well. We've got people globally researching the best managers.
No, it's a really interesting approach. So, doing some research for the show, we came across that Russell have just released a new, account offering. Mm-hmm. Just wondering if you can explain what that is and how it's different to sort of anything that's on the market at the moment, because it really appears that the way you guys are marketing it seems to be something that's not really widely available.
Yes. Most of our offerings to the marketplace so far have been managed funds. So a managed fund is perhaps a 70% growth portfolio, so 70% invested in shares, property, and 30% in bonds and cash. So we'll run a fund like that, and advisors will use us to invest their clients' money in those sorts of funds. What they'll tend to get, though, is when the advisor and their client are sitting down and talking about the Russell Investments Balance Fund, for example, they've got a single line item on their statement. So it looks to the client, to the end client, like a black box. They don't know. They can get the information, but it's not really clear what's underneath that Russell Balance Fund. And what's underneath it is over 50 managers, lots of different asset classes, a huge amount of diversification, but it's not clear to see that if you're just looking at the statement. So managed accounts have become more popular in Australia, certainly in the last few years, and a managed account really unbundles this concept of a diversified fund and makes it much more transparent to the end investor, much more personalized, and I'll explain why in a second. But it's almost applying that personalized technology experience that we're all getting now from Netflix and Amazon and Spotify to the world of investments. And as you'd imagine, personalization is something that's desired in all spheres of our life now and expected by all of us. And the investment space is not immune from that. So When I say personalisation, what a managed account is, it'll be an aggregation of some funds, some ETFs, and some direct shares. And the direct share component is where there is the ability for an investor to personalise what they're holding. So they might want to exclude something that comes in the standard Aussie equity componentry. They might want to add something in. They can work with their advisor to figure out exactly what they want in that Australian equity space. So managed accounts increase transparency to the end investor, provide great diversification, but allow the ability for personalisation in the Aussie equity space at the moment, which also improves tax outcomes as well, because you have beneficial ownership of those Aussie equities.
The investor almost gets to create their own fund of funds in a sense.
Kind of.
Is that right?
Well, not quite. So a bit kind of. So they're able to create their Australian equity component. We'll give them a starting point.
Right.
We'll give them a starting point, so a 25 stock portfolio, and they can adjust from there. But everything else is constructed for them with institutional quality, asset allocation advice, manager research, access to great funds. So it's the personalisation is in the Australian equity component, but not so much in the rest. And most investors, I think, Bryce, would have some desire to personalise more in the Australian equity component, but might not know as much about real estate investment trusts or bonds or things like that. So it tends to work with interest level of investors as well.
Yeah, it's interesting. Is there a minimum account balance that you need to get started with one of these?
No, that's a good question. It will depend on the platform. So the way that we're offering our managed account to the marketplace is through advisors on some of the platforms that are available. So our managed accounts are available on Premium. Soon they'll be available on Hub24 and then on Netwealth. So I don't think there's a minimum investment, but I'd have to double check that. So the managed accounts that we're offering are in this nice sweet spot in between a fully active managed account and a fully passive managed account, because advisors have told us that they want to be able to offer their clients something in between. So the managed accounts we've created have three main parts. One is a dynamic core. So this is a real return fund. That's a Russell fund. It's outcome oriented. And it's managed dynamically. So we're able to adjust and incorporate our views on various markets and asset classes. The other third is the Aussie equity portfolio. As I said, it's the 25 stock portfolio. So we start with our views on factors in the Australian equity market to funnel the ASX 300 down to a smaller number, and then choose the best stocks from that. And the last third is a mixture of ETFs. So some Russell ETFs and some other provider ETFs. They're about giving a more diversified asset class exposure at a decent price point.
And is it evenly sort of split between all those three?
Yeah, it's roughly a third. It's not exactly, but roughly.
Is there a reason that you guys choose 25 stocks in the Aussie equity part? Is it always sort of 25, or is that just the starting point and then the client can go in and fiddle around?
I think 25. So ideally we'd like to have a lot more stocks, but it links back to your question before, Bryce, about what's the minimum investment. So you want to have a lower number of stocks so that people are able to access the diversification in that portfolio. So if people are investing lower amounts and there's a 200 stock portfolio, you've got tiny portions of shares all over the place, and it's inefficient and a bit clunky.
No, it makes sense. So I want to move to the advisor part of the conversation. You mentioned there that this is a product that sort of the advisors themselves had been, I guess, asking for to give to their clients in between, full control and no control. So Russell Investments recently released its second annual Value of an Advisor report. Now, the report looks holistically at the real value of advisors and what is the value that they actually deliver to their clients. And this is something that, as I guess a beginner investor, it's something that we think about. We'd love to get access to an advisor and maybe run a couple of questions past them, but we always think, do we have enough of a pool of capital to actually make the ongoing cost of an advisor actually worth it.
Mm-hmm.
So I'd love to discuss this report in a bit of detail. Firstly, how do you define advice in this situation, and can you explain the distinction between an advisor that you look at in your report and then perhaps like an investment-only advisor?
Sure. So advice is working with a client or with a family around helping them achieve their financial goals and life goals in a realistic way whilst managing their risks. So that is the easiest definition of a holistic advisor. If you're seeing an advisor and it's only based on investments, there might be issues that are missed that are really important. So there might be issues that are important for the advisor to understand around insurance, around your family situation, around a potential inheritance that you're expecting. The advisor really needs to have a broader understanding of an individual situation to really deliver the broader wealth and planning services that we think are a really important part of the overall advice experience and value add.
So in terms of value add, the report mentions the ABCs of an advisor value. Are you able to go through what the ABCs are and really not sort of make clear in the report, I guess, what is an advisor actually adding in value?
Sure. Okay. So the formula that we use is ABCPT. So this is the second year we've produced this value of advice report in Australia. We've done it for 5 or 6 years in the US and Canada. And we think that this year in particular, we feel very strongly about being in advisors' corner because there's been a lot of negative publicity around advisors post-Royal Commission. But the reality is the vast majority of people that are partnering with an advisor get value add that far exceeds the fees that they pay. So the ABCPT formula, A stands for annual rebalancing. So a lot of investors, if left to their own devices, won't rebalance their portfolio. So this can mean that a 70% growth portfolio, so 70% exposure to shares and property, if you leave that for 10 years, it'll end up looking something like an 85% growth portfolio 10 years later, and that it's not delivering the risk profile that it was intended to. So by annually rebalancing a client's portfolio, an advisor's making sure that they're staying true to the risk profile and that the investments of their client do what they say on the tin, if you like. So in terms of the quantum we've attached to that, we've actually given that a positive number, but we haven't put a number down because it's extremely variable. It depends on the time period that you're looking at. It depends on what happens in markets. But in the US, for example, we say that the annual rebalancing adds 10 to 30 basis points to a client's portfolio over the long term. In Australia, we say it's a positive impact, but we're not putting a number on it just yet. So that's A. B is the largest component of the value added that we consider advisors to give is around behavioural coaching. So advisors don't control markets, but they can have really good conversations with their clients so that their clients understand human behavioural biases, and advisors can help individuals make more disciplined decisions. So behavioural biases, there are over 200 behavioural biases recorded, and really partnering with an advisor is partnering with a coach who will save you from yourself. Even people that know a lot about investing make investment mistakes based on these behavioural biases. So things like overconfidence. So everybody, if you ask people, way over half of people will say they're a better investor than average. So people are overconfident in their abilities. People hold on to stocks for too long, so that there's loss aversion. People in Australia, actually, it's a particular issue, herding. So this is the notion that as a stock or a sector is going up, people pile into it, buy more and more and more and more and more. So they're buying at a high price. Then as that stock or market or sector starts to drop, retail investors tend to sell out. So they're buying high and they're selling low. It's this FOMO around, fear of missing out on the upside and fear of not getting out on the downside. So partnering with an advisor to avoid these behavioural mistakes, we think can add about just under 2% per annum to an individual's portfolio over a lifetime of an advice partnership. So,
interesting.
Yeah, so the next one is C, and C stands for the cost of getting it wrong. So this notion is left to our own devices, we might not choose the right investment portfolio to deliver our return objectives that's appropriate for our time horizon, and so on and so on. So there's research that shows that over 80% of under 35-year-olds want guaranteed or very, very stable returns. And from an investment perspective, if you're under 35 years old, you've got time on your side. So having a really conservative portfolio is not necessarily the best thing for you. So working with an advisor, they'll be able to coach you to explain that and show you that. And the difference between, say, a 30% growth portfolio, a conservative portfolio, and a more growthy portfolio with, say, 70% exposure to growth is about 1.6% per annum over, say, a 20-year period. So an advisor working with you to get your investment portfolio right adds a significant amount as well. So that's the ABC. Now we're up to the P and the T. The P is planning. So it's a misconception that advisors are providing investment solutions to their clients only. The best advisors are providing a holistic wealth management service. So that can include things like helping with insurance, helping fund children's education, helping with aged care solutions for elderly people in your family, for estate planning, and so on and so on and so on. So having this deep two-way conversation between an advisor and a client means that you're covering all of that stuff. Now, we have not put a value on this one. So there's two of the ABC PTs we've not put a value on, but said, it's very hard to quantify this, but certainly when it comes to the P and the planning side of things, we think that's invaluable. And everybody, Bryce, that you speak to will have some story of, something that's happened to a family member and their advisor has helped them to deal with that. So I've got my own personal story. So about 5 years ago, I was diagnosed with breast cancer, and I was sort of working through what kind of treatment we were going to do and so on and so on. I didn't know if I would be feeling well, if I'd be able to work. I really didn't, you enter into that not knowing how things are going to go. And my advisor reminded me that she had recommended trauma insurance to me, which I'd never in a million years thought that I would use. And she said, oh, well, you can claim this. And I was a bit surprised. I was like, really? So I was able to claim on that trauma insurance, and it gave me additional peace of mind when I didn't know if my work pattern was going to be interrupted. You're just facing a lot of unknowns, and having some security to help you through that was like, that's priceless. That's super, super valuable. And I know lots of people have stories like that. So that's the P. The last side of things is around tax. So it's very, very hard to keep up with superannuation tax law. Even those of us that work in superannuation and investments day to day still need someone to help keep us on track and keep us up to date. So advisors are making sure that they're on top of tax legislation at any point in time, and that they're keeping you from falling foul of the ATO, which nobody wants to do. Yes, everybody's worst nightmare. So advisors can help you optimize your superannuation contributions, and then in the accumulation stage, so when you're still working and contributing to super, and then as you're thinking about stopping work, they can help with transition to retirement strategies and things like this to optimize your tax, your post-tax investment returns. So that tax management side of things is, we think, adds 90 to 120 basis points to an advisor's value. So all in, our estimation, and it's just the starting point. I've mentioned a couple of things that we think are a really big part of the advisor value proposition that we haven't put a number on, but just said this is worth something. But with those few things that I've mentioned, we think that an advisor adds at least 4.4% per annum to an individual's returns over a lifetime. And just one last point on that to sort of make that real. This means if you start at 40 years old with some small savings, this can add $550,000 of extra wealth over a lifetime. So say from 40 to 80 years old. That's huge. That's the difference between, overseas holidays in retirement or taking a caravan up the coast, private healthcare versus public healthcare. Like, that's a meaningful number for most Australians.
No, there's no doubt. I think that financial advisors certainly offer value for investors, or even, just your general mum and dad, at certain points in their life. I'm wondering if that 4.4% is taking into consideration the actual cost of the advisor?
No. So that is something for an individual to think about as they're thinking about entering into a partnership with an advisor, is to have a look at the cost that an advisor is going to charge you, or the fee that they're going to charge you, and compare that to, have a look and see if you think that's worth it against what we say is 4.4% per annum over a lifetime. And advisors generally charge much, much less than 4.4% per annum.
So 2 questions then. Do you have an opinion, or does the report go into much detail about the ideal time, I guess, to start working with an advisor? Because from I guess, our point of view, tax and wealth planning and that sort of stuff may not seem so important right now. And I'm just wondering what are your thoughts around that, considering, I guess, that the cost may be quite off-putting for your younger retail investor?
Mm-hmm. No, that's a really good question. I don't think that there's necessarily a right answer. I think that there are more and more tools to help you start on your investment journey as early as possible. So some of the micro investing apps are really, really good, where these roundup apps where you buy a cup of coffee for $3.50. I don't know how much a cup of coffee is anymore. $3.50. I think I've undershot that one. $4.50. It rounds up to 50 cents and funnels that 50 cents into equity investments. So they're really good things for younger people. I think younger people can also have a look. Your super fund will generally have a range of tools around trying to set a desired income in retirement. Like, it feels like 100 years away. It won't be 100 years away for most of it. So, it's really interesting, Bryce. We did some Vox Pops in Pitt Street Mall in Sydney, and we were speaking to people about salary, and said to people, do you know what your current salary is? And of course, everybody says yes. And we say, have you given any thought to what kind of salary you would like in retirement? And like, hardly anybody said yes. They're like, I don't really know. I haven't really thought about it. I haven't spent any time on it. So as individuals, we spend a lot more time thinking about a salary we might have for a few years versus a retirement salary we might live with for 20, 30, 40, 50 years. But your super fund will have, good super funds have tools online to help you play around with that and think about and plug in, here's when I think I'd like to retire. Here's how I'm invested. This is what kind of life I can expect in retirement. Here are some strategies to, should I increase my investment risk profile? Should I increase my contributions? So there's some easy ways to access some of the information that I think is most helpful when you're younger. So for me, I think it's when you are getting a bit older, you need to think about wealth protection and insurance. You maybe have a mortgage and have paid some of that off, and you're starting to think about what else you can do to grow your wealth. So for me, it was mid-30s when I first used an advisor.
Yeah, I think you're right. Depending on life stage, perhaps not right at the beginning of an investing journey while you're still at university, you're not really needing to think about wealth protection because it probably all goes to the pub or textbooks. So I think, yeah, certainly as you get later, I can definitely see some of the value that the advisors can give. What do you think are some of the key things that we should be looking for when it comes to choosing a financial advisor? Because there's 1,001 out there, and perhaps to couple with that, are there any red flags that we should instantly, I guess, recognize to then walk away from an advisor if we do come across them?
Okay, so two things to look at when you're choosing an advisor. First of all, there's the formal stuff. So looking at the qualifications, whether they're a member of professional associations. The main thing, though, is there's a financial services guide that the advisor is obliged to give you. So that speaks to who they represent, the fees that they charge, their qualifications, and so on and so on. So that's ticking the formalities off. Just as important is the informal piece. So this is around relationship fit. So, we've all had personal trainer or a hairdresser or, a teacher or a lecturer that we get on with and we just understand each other. You want the same things with an advisor. You want somebody that you're comfortable with and that you trust, and you're happy to speak to them about your financial and personal issues. So what we suggest is it's a good idea to have an initial appointment with perhaps a couple of advisors. They won't usually charge you for that, and just see who it is that you work best with. I did that, and people might have slight differences in fees, but really it comes down to, I think I can work really well with this person.
No, it's a good point. I went through one of those intro sessions with an advisor maybe 6 months ago, and it was like sitting an interview, and I just didn't feel like they were really going to be able to offer me anything other than probably what I could already try and do through my investing. So definitely can relate to that, finding a fit. How do you see the role of an advisor changing post-Royal Commission? Obviously, the Royal Commission's come in and really shaken things up. Mm-hmm. Has that impacted the value that they are going to be able to deliver, do you think?
I don't think it affects the value that they can deliver so much. I think that I think certainly the cost of delivering advice is going up. So there are increasing compliance requirements on advisors. So I think that on average the cost of advice will go up. You also, historically, advisors have received some of their revenue through product-related commissions, and that's been slowly ending, but it will, post-Royal Commission, it will end faster. So it's becoming, the advice profession is becoming more like seeing your accountant or seeing a tax agent or something like that, where there's a dollar fee. It's more of an hourly based fee, and this is the fee and this is what you get for it. There are not product related commissions. So the value isn't changing, but the way that the advisor is paid and the cost of delivering advice to an advisor, I think, is changing.
Interesting. So then on the change piece, what do you think the future of financial advice looks like, given, I guess, the speed at which technology is driving change in the world? Mm-hmm. We've interviewed a couple of people that CEO and founders of some robo-advice companies, and they're starting to now target that, I guess, market that wouldn't really need the full value that an advisor would give, just more of an investment advice. Mm-hmm. How do you see sort of Russell playing in that space, or if you were to do this report in 10 years, what do you think the financial advice world would look like? Yeah,
that's an interesting question. I think I certainly think that the role of robo-advice will increase for a few reasons. I think you will have heard about the great shift in wealth from baby boomers to the younger generations that's going to happen over coming years. Those younger generations have been raised on iPhones and technology, and don't use the mobile phone to call somebody, and they're a bit confused when someone rings you. Like, they're just from a technology perspective wired differently to, say, baby boomers. So I think that there's going to be increased appetite from the younger generation to get more technology-driven advice, particularly, as you say, in the early stages when you don't have loads of money to invest, you don't have a lot of problems that you're trying to protect against, and you're just looking for a little bit of help and a little bit of guidance. So I think that robo-advice is great for that kind of market. On the other side, from an advisor's perspective, I think we'll see more advisors using robo-advice as a way to sort of efficiently engage with younger people without the level of assets that they'd normally require, and to be able to engage with them in a way that's far more cost effective. So I think there'll be robo-advice sort of on its own, and potentially robo-advice within the framework of an advisor practice or advisor business. For us, we're certainly working we have a superannuation fund. We are working to offer a personalised MySuper default, which is what you get if you don't make an investment choice. You get defaulted into the MySuper default. So that effectively is robo-advice. So we'll be the first to do that without an advisor attached in the Australian market. So I think that robo-advice will be far, far more accepted when we write this report in 10 years' time. It'll be a very accepted way for younger generations to access some of that information.
Yeah, it's a super interesting space. I think if you look at where the states are in terms of their penetration of robo-advice compared to Australia, we've obviously got a lot of room to grow in that space. I still think though that there's a bit of a forgotten market in terms of, a product that is cheap and accessible and still gives you some of the value of a personal advice that's not so robo, but, I understand the unit economics of doing these sorts of things. So yeah, very interesting space. I'm very much looking forward to seeing how it all plays out over the next sort of 5 to 10 years, because as you said, the wealth transfer that is going to happen is going to be large, and if us young ones don't know what to do with it, then all hell could break loose.
Yes, indeed. Buy like fancy cars and things like that.
So, Jodie, that brings us to the end of our interview. I think it's been a great insight into, what the value of an advisor can be for an investor or, just anyone looking to, I guess, get ahead with their financial situation. And as we spoke about, it's obviously something that is not for everyone at every stage in life, but something that should be considered as you start to build up a bit of wealth. We always like to finish our interview with the same 3 questions to all of our guests. So I will hit you with the first one, which is, do you have any must-read books, investing or otherwise?
So I did my CFA, so I've read all the investment textbooks. So I like to read other sorts of things. So when I was younger, I read a lot of things like Tony Robbins, Rich Dad, Poor Dad, 7 Habits of Effective People. But yeah, my must-read books are really around non-investment topics.
What is your go-to source for investing information, or where do some of perhaps your advisors turn for investing information?
So I read the AFR every day online. I like the AFR. It has really, really good information. And certainly if you're starting out from an investment perspective, one of the best things you can do, and we say this to some of the young people that join our business, read the AFR every day. When you don't understand a term, look it up, and every day you're building on your knowledge there. But that's a good place to get market information, company stories as well, and you're sort of building your own investment glossary there. Some of the advice, the challenge now is that there is so much information about investments. It's almost harder to figure out what to read and what to exclude, because we get bombarded all of the time. So we at Russell Investments on LinkedIn, we push out a weekly market update post. Advisors like that. There'll be other sources of information that they're using as well.
Yeah, nice. I certainly resonate with the AFR. It's how Ren and I both got started and still read it every day. So yeah, absolutely great source of information, and, really does cater to all levels. So Final question: what would you tell your younger self?
Don't borrow money to buy a car.
Nice.
And to buy a rubbish car. And when you're borrowing money to buy a rubbish car, don't throw in an extra couple of $1,000s to buy new clothes. That's the kind of stuff you pay off for years and years and years.
I'm sure if you had a financial advisor at the time, they would have strongly recommended against it.
Absolutely, Bryce. I would have said that was a really silly thing to do.
So, Jodie, thank you for your time. Really appreciate you coming on. Quite a unique insight into the value that advisors can give, and also really interesting chatting about the new managed accounts that Russell offer and how you guys are starting to think about different ways of, creating products that suit all levels of not only advisors but their clients as well, and catering to all their needs. So I really enjoyed chatting, and really appreciate you coming on the show. So thank you.
Thanks so much, Bryce. I enjoyed it very much as well.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity Mates.